So just take us through the thinking. This U.S. equity markets, can it stop rallying? Will it stop rallying?
Well, the good news is record high corporate profits, more to come in 2025.
Okay.
In every likelihood. Really nothing inhibiting the economy from growing further. Corporate profits underperformed last year. If you take a look outside the Mag 7, U.S. EPS were down 6.5%. They're in recovery. I think by the end of the year, 10 out of 11 sectors will probably post EPS gains this year.
Okay. And that's beyond just the tech space, you think?
That's beyond the tech space. And if you think about it, Mag 7, you're probably looking at 20-25% EPS gains. Now, last year, 96% return. So obviously a bit baked in. And I think, most importantly, think about tech service providers may end up competing in the same AI space going forward. So there's an AI boom going on. It's very small in the context of the whole economy. It's not creating some kind of aggregate boom. The labor market is slowing. The labor market outperformed. We had, as you noted, a strong year for employment, a down year for profits. We think that reverses over the course of this year and into next. And we've been basically out of sync ever since the pandemic, and that's what's happening here. Nothing V-shaped, but certainly a stronger profit outlook.
Right. And the investment advice then would be specifically what? Lean into tech, broaden it out, buy the index?
So everyone is probably passively seeing big increases in their tech exposure.
Yeah, well,
innovation, you've got to stay with it, even if it doesn't look like it's matching any kind of conventional valuation measures. When fundamentals are improving and innovation is the primary driver of equity returns. But now we think you can broaden out, you can diversify, you can take less idiosyncratic risk on a few companies because 10 out of 11 sectors and multiple parts of the world economy are going to see improving profits. So you can take down your risk some and be a little less greedy with the headlines.
Okay. What do you think, what part of this market is indiscriminately ignored and shouldn't be ignored right now?
Well, look, whether or not it should be ignored, for global investors, you're taking a look at, a deeply depressed China.
Yeah.
You're looking at the property market. Some of the measures are off 57%. You couldn't repeat that decline again, right? And it's not to say that anything comes back quickly, and there are, obviously political, economic dynamics. If you were a long-term global investor who's not overweight China, who's not, there, you'd have to think about that as a potential for a turnaround. It's a really lagging part of the global market at this point, and you just want to consider that. But you're given a wide range of opportunities. Income is back. At the core portfolios in fixed income.
Yeah.
You can build 6% yielding U.S. dollar portfolios for 4 to 5 years. We talk about portfolio returns compounding at 7%. It doubles your money in 10 years. It's important to note that if that is achieved, you can do this with assets that don't go up and down 20% every year. Right? You can actually do this in a sustainable way in portfolios because we basically restored income and value in many parts of the equity market outside of the big innovators in large cap tech.
Yeah, we're just firing this chart just as a bit of background here for our viewers. Certainly when the data suggests if you have a global asset allocation model, if you diversified away from the U.S., you wouldn't have done very well compared to sitting on the S&P 500. So I guess the question is, there is a value to maybe diversify your bets. It's very hard to sell that, though. If
to U.S. investors
to U.S. investors in particular, too, because their home market has just gone absolutely berserk.
Look, to be fair, we're 4.5% overweight U.S. equities. If you look at our thematic weightings, we're 3% overweight global. So we have some underweights in non-U.S., but we have to look. U.S. market cap has risen to about 2/3 of the world.
Right.
It is because earnings have grown faster, but market cap's grown even faster. And if we take a look through history, we can't find, any cases in modern times where the U.S. had some sort of crisis that the world didn't, right? But generally, taking advantage of undiscounted value in other markets, diversifying. We're not even talking about equalizing valuations. That's not even part of our thinking.
Okay.
But the catalyst of a broadening global expansion, broadening global profits, should be sufficient for all these markets left in the dust.
And that's despite, global central banks right now seem to be really hesitant to kind of kick off this easing cycle.
Well, ECB, Canada, Switzerland, look, I think people will see that the Federal Reserve doesn't sit still. It's a highly activist central bank. It's given all the excuses in the world other than the trailing data just aren't just perfect yet. The Federal Reserve never sets monetary policy to set it and leave it. It's very, very different from Japan, for example. Right? Couldn't be more different. It's constantly trying to micromanage. Accommodative and restrictive monetary policy, these two terms are set, different from the long-term norm. It says that long-term norm is 2.8%. Right now, at the top end, 5.5%. So we think in the next couple of years, monetary policy will relax. The U.S. will try to protect the expansion, and that's because of the labor market, which we think will soften.
Where are we in the cycle?
Well, think of it this way.
Yeah.
If you wanted some sort of massive bust, you'd have to have a boom. And like I said, there's some narrow boom signs, within AI, nothing that's driven up the broader economy to anything that looks like a boom. What we've had is a lot of stimulus during the pandemic years, and we had a rescue in reverse, try to take all of that away, and the private sector never got into a really strong boom dynamic. So I think it's not that vulnerable. And we could find that this could be a very long expansion, even if it's unremarkable, compared to what we've had in the past, which have been, 9-10-year cycles. It's possible.
Yeah. And Steve, it's interesting. It's rare that we hear U.S.-based guests like yourself be so optimistic about China, I feel.
Optimism it's kind of hard. It's really, what we saw is a lot of endogenous technology in China, very different from other emerging markets. And, that being something you could be optimistic about for many years until the situation changed and companies were not allowed to perform in the way that they had, during the run up to, let's say, 2021.
Okay. How are you increasing your allocation then to China?
Well, look, it's very measured.
Okay.
Close to benchmark. We're talking about, 4% allocation of a global portfolio. Yep. That's a mix of, a wide range of assets. When we hear about clients, who have put all of their money down, taking a very, very, strong view, they're looking at big losses behind them in both credit and equities markets. I have to look at that from the perspective of what sort of untapped value is there. But we approach this cautiously. And again, there's a lot of things that are going to happen. There are particular political risks in the U.S. that could impact China more than some other markets. Broader Asia, though, is an area where there's a lot of capital deepening. There's more capital per worker, which generates economic growth. In some places, it's been allowed to show through to profits and shareholder returns. Japan is an example. We're overweight. It's worked in India to a certain extent. And these other markets. Look how strong Taiwan's market is. Right? Again, with technology, which again was widespread across the region, in some cases, certainly in China, let's just say. And it's not been impossible for markets like Japan and Taiwan to have strong returns.